Right now, the purchasing power of the cash in your wallet is actually being threatened by this tiny 21-mile stretch of water on the exact opposite side of the world.
Yeah, it's wild to think about.
Right, because we tend to think of global finance as, I don't know, something purely abstract like algorithms running in a basement somewhere or just traders staring at red and green numbers on a screen.
Oh, absolutely.
Oh.
But it is a stark reminder that the economy isn't weightless. All that data moving through fiber optic cables is ultimately tethered to physical commodities moving through very narrow, very physical bottlenecks.
Exactly. And to understand how a geographic bottleneck actually changes the value of your money, we are doing a deep dive today into an April 2026 market analysis report. This is by Doug Young, published in the Gold IRA Company's Bulletin.
It's a fantastic report, really lays it all out.
It really does. So our mission here is to connect the dots between a recent, really intense geopolitical conflict, global shipping lanes, and a massive structural shift in the global currency market.
Right, the macro and the micro colliding.
Yeah. And just a quick note on the context here before we jump in. The catalyst for this economic chain reaction is a conflict involving a U.S. and Israeli attack on Iran that started on February 28, 2026.
Important to note, yeah.
And we are not taking political sides on that conflict. Not at all. Our goal today is strictly to, objectively unpack the data from Doug Young's report and explain the massive economic shockwaves this event triggered.
Right, because the underlying political dynamics are incredibly complex.
Hmm.
But the resulting economic data, well, that's highly measurable. The fallout from this specific military action has basically accelerated trends that financial analysts have been tracking for years.
So let's start with the physical reality of this choke point. We are talking about the Strait of Hormuz. It is the only maritime outlet from the Persian Gulf to the Gulf of Oman. Now, I know it's a major energy corridor, but what is the actual scale of trade moving through there daily?
The scale is honestly difficult to overstate. The Strait of Hormuz handles roughly 20 to 21 million barrels of oil every single day.
Wow, 20 million.
Yeah, which represents about 1/5 of the entire world's petroleum liquids consumption. So like 1 in every 5 barrels of oil used globally has to squeeze through that specific waterway.
That's insane.
It is. And it also handles roughly 20% of the global trade in liquefied natural gas, or LNG, which is primarily originating from Qatar. And the vast majority of these energy resources, around 67% actually, are destined for Asian markets. So specifically China, India, Japan, and South Korea.
And the real vulnerability here is just the geography, right? Because at its narrowest point, this strait is only 21 miles wide.
Just 21 miles. Yeah.
It is a massive volume of the world's most critical economic lifeblood being funneled through a tiny straw. Which brings us to the fallout from that February 2026 conflict. Following the attack on Iran, the Islamic Revolutionary Guard Corps, the IRGC, they retaliated in March.
Right, but it wasn't a conventional military response, which is what surprised people.
Exactly. They imposed a toll on ships transiting the strait.
Yeah, they instituted this highly specific transit fee. The IRGC began demanding approximately $2 million per vessel just to pass through.
$2 million a ship.
But the critical detail, and really the focus of Doug Young's analysis, isn't the amount of the toll. It is the currency they are demanding. Iran is straight up refusing U.S. dollars.
Wow.
They are mandating that these tolls be paid exclusively in Chinese yuan.
Okay, so think about it like this. Imagine you're driving down the world's most critical highway. Suddenly, it funnels down to a single lane and a brand new toll booth pops up. But the toll operator refuses the cash in your wallet and demands a foreign currency you don't even carry.
That requirement is just a textbook example of financial weaponization. Because by mandating payment in Chinese yuan, Tehran completely circumvents the international sanctions that normally, freeze or block their access to U.S. dollar transactions.
Right, they just bypass the whole system.
Yeah, exactly. And if this toll is fully implemented across the board, the report estimates it could generate up to $6.4 billion annually for Tehran. And that is entirely outside the jurisdiction of Western financial regulators.
$6.4 billion. And it is already fracturing the logistics of global trade, right? Like, the report points out that ships linked to China and India are receiving preferential treatment and smoother transit.
Oh, absolutely. They just sail right through.
Meanwhile, Western carriers are facing massive delays. They're being forced to reroute all the way around the continent of Africa or engaging in, intense diplomatic back-channeling just to get through.
It's a logistical nightmare for Western shipping.
But I want to pause on the currency aspect because Iran demanding yuan instead of dollars isn't just a random choice to annoy the West. To understand why this is such a seismic shift, we have to look back at the origins of the system they are attacking. We really need to talk about the petrodollar.
Right, the petrodollar. So to understand this, we have to rewind to the early 1970s. In 1971, the U.S. decoupled the dollar from the gold standard.
The Nixon shock.
Exactly. So the dollar was suddenly a fiat currency. It was floating and, honestly, vulnerable. To stabilize it, the Nixon administration struck a pivotal agreement with Saudi Arabia in 1974. Riyadh agreed to price all of its oil exports exclusively in U.S. dollars.
Exclusively?
Yes, and in exchange, the U.S. provided military protection, weapons, and economic support to the Saudi kingdom.
So overnight, basically, if any country on Earth wanted to buy oil to power their economy, they were forced to acquire U.S. dollars first.
That is the core mechanism, yeah. It created a permanent structural global demand for the U.S. dollar. Every single oil-importing nation had to maintain massive stockpiles of dollars just to function.
Wow.
But the real geopolitical leverage came from what happened next. Countries like Saudi Arabia were suddenly sitting on mountains of cash, and they needed a safe, liquid place to store it. So they recycled those dollars back into the U.S. economy by purchasing U.S. Treasury bonds.
Oh, man. So they were essentially taking the money they made from selling oil and lending it directly right back to the U.S. government. That is an incredible feedback loop. I mean, they sell oil for dollars, use the dollars to buy U.S. debt, which then finances U.S. government spending, and that just completely cements the dollar as the undisputed global reserve currency.
It allowed the United States to run massive deficits for decades without suffering the kind of hyperinflation that would destroy a normal economy. The rest of the world was basically forced to constantly absorb our debt just to keep their own lights on.
Wait, hold on, though, because if I look on, Twitter or financial blogs right now, there are a million posts saying the petrodollar officially died in June 2024.
Ah, yes, the rumor mill.
Yeah, people were posting as if a physical contract had literally expired and Saudi Arabia just walked away. Are you saying they are all just wrong?
Well, the internet dramatically oversimplified the reality of that situation.
Sure.
And Doug Young's report directly addresses this misconception. The 1974 pact was an informal understanding. It was a geopolitical handshake, not some legally binding time-limited contract.
Okay.
So there was no piece of paper that simply expired in June 2024.
So the dollar didn't just get globally canceled overnight.
Not at all.
Or
Saudi Arabia continues to price the vast majority of its oil sales in U.S. dollars today.
Yeah.
What changed, and this is the really crucial nuance, is the exclusivity.
Ah, the exclusivity.
Right. Saudi Arabia began officially accepting other currencies for some of its oil exports. Most notably, they started accepting the yuan for certain strategic sales to China. So the monopoly ended, but the market dominance remained.
Got it. And it isn't just Saudi Arabia dipping their toes in, right? The report shows that energy deals between China and Russia are now settled 90% in yuan.
90%, yeah, it's massive.
That means practically their entire bilateral trade is happening completely outside the US dollar ecosystem. But, okay, if two other countries decide to trade oil in yuan, how does that actually impact the person listening to this right now? Why should an American consumer care if Russia and China swap currencies?
It comes back to that feedback loop we discussed earlier. If countries aren't using dollars to buy oil, they don't need to hold as many dollars in reserve. And if they aren't holding massive dollar reserves, they aren't buying as many U.S. Treasury bonds.
Oh, I see.
Yeah. So when the U.S. government has fewer guaranteed foreign buyers for its debt, it has to offer higher interest rates just to attract investors.
And those higher government bond yields eventually trickle down to the domestic economy.
Right, meaning it makes mortgage rates, car loans, and credit card debt way more expensive for the everyday consumer.
Exactly.
So a geopolitical handshake in Beijing eventually makes a 30-year fixed mortgage in Ohio more expensive. That really connects the macro to the micro.
Yeah.
But I'm curious about the actual mechanics of this. Because if a country decides to stop using dollars for oil, how do they actually pull that off? The global banking system is practically hardwired for the dollar.
Well, this is where we see the architecture of a brand new financial world being built. And it's largely led by the BRICS bloc: Brazil, Russia, India, China, South Africa, and all their newly added members. Great.
They are actively constructing alternative financial networks to completely bypass Western infrastructure. To understand this, you really have to understand SWIFT. SWIFT is the messaging network that banks use to send money across borders.
Right, everyone's heard of SWEST.
Yeah, but SWIFT is just the messaging system. Because the transactions are in dollars, the actual settlement has to flow through a U.S. correspondent bank.
So even if a bank in Brazil sends a message to a bank in India, if it's in dollars, an American bank is sitting right in the middle of that wire transfer.
Yes, and because an American bank is involved, the entire transaction falls under U.S. jurisdiction. If the U.S. government decides to sanction a country, they simply order those correspondent banks to reject the transfers.
Wow.
That is how the U.S. weaponizes the dollar. To escape that, BRICS nations are building platforms like Enbridge and BRICS Pay.
Okay, so how does Enbridge actually avoid the U.S. correspondent bank? Like, what is the technological difference there?
Well, Enbridge uses central bank digital currencies, or CBDCs, and they operate on a shared blockchain ledger. So instead of relying on a chain of commercial correspondent banks to clear a transaction, the central banks of the participating countries connect directly to each other on this shared digital platform.
Oh, that's huge.
It is. A payment from the UAE to China can settle instantly in their local digital currencies. It entirely bypasses the U.S. banking system and, by extension, U.S. sanctions.
Wait, so building Enbridge is one thing, but getting people to actually use a brand new, unproven financial network is another. Is that what the Strait of Hormuz toll is really about? Like, is Iran using a physical choke point as a forcing function to make the world adopt this alternative digital plumbing?
That is exactly the escalation the report highlights. We have seen non-dollar transactions for the commodity itself, like buying the actual oil. But Iran demanding yuan for transit tolls, that is a historic first.
Right, because it's infrastructure.
Exactly. It is the first major instance of a key global energy choke point demanding non-dollar transit fees. They are actively leveraging physical geography to force international shipping companies to interact with this new non-dollar financial architecture.
And if these countries are successfully trading oil and charging tolls in local currencies, bypassing SWIFT and avoiding U.S. dollars entirely, they run into a massive anchor problem. Because if they aren't hoarding U.S. Treasury bonds to store their national wealth anymore, they need a different kind of bedrock. What do central banks buy when they don't want to buy U.S. debt?
Well, the data points very clearly to physical gold. We are witnessing a fundamental shift in how sovereign nations manage their balance sheets. The Doug Young report details that central banks acquired over 1,000 tons of gold annually from 2023 through 2025.
1,000 tons a year.
Yes. And projections for 2026 show continued massive accumulation, estimated between 750 and 850 tons.
The report actually breaks down the 2025 liters, and the volumes are staggering. China bought 225 tons in a single year, India bought 100 tons, and Turkey bought 95 tons. I mean, this isn't passive investing. It is a coordinated, massive accumulation of physical metal.
Oh, for sure. To put that into historical context, these volumes represent the strongest, most sustained central bank buying spree of gold since the 1960s.
In 1960s.
Yeah. And the mechanism behind this shift is really all about risk. You see, U.S. Treasuries are what we call a yielding asset. They pay you interest. Gold is a non-yielding asset. It literally just sits in a vault. It doesn't generate income.
So why are the world's largest financial institutions trading an asset that pays them money for a heavy metal that just collects dust?
The answer comes down to counterparty risk. When you hold a U.S. Treasury bond, you basically hold an IOU from the United States government. You are completely relying on a counterparty to honor that debt.
Right, it requires trust.
Exactly. And as we saw when Western nations froze hundreds of billions of dollars in Russian central bank assets, that counterparty can simply erase your wealth with the stroke of a pen if you run afoul of their geopolitical interests.
Ah, and the 2026 World Gold Council survey cited in the report backs that up perfectly, doesn't it? 29% of central banks specifically listed geopolitical risks as their primary driver for buying gold over the last few years.
Yep, because physical gold carries zero counterparty risk. If a central bank holds sovereign gold in its own domestic vault, no foreign government can freeze it. No one can sanction it. It is entirely outside the digital reach of the Western financial system.
That makes total sense.
They are willing to give up the yield of a U.S. Treasury bond in exchange for the ultimate geopolitical insurance policy.
It's like sovereign financial prepping, you know? Instead of an individual stockpiling bottled water and generators in their basement to survive a grid failure, you have entire nations hoarding physical gold bars to prepare for a multipolar economic reality where the U.S. dollar is no longer a guaranteed safe haven.
That's a great analogy. They are structurally hardening their national economies against the specific type of financial warfare the United States has relied on for decades.
So we've covered a massive amount of ground here, from Iranian tolls to BRICS digital ledgers to central banks hoarding gold. Let's bring this back down to the immediate reality for you, the listener. How does a disruption in a 21-mile strait physically alter your domestic economy?
Well, the physical logistical disruption translates directly into consumer inflation. We noted earlier that 82% of the crude flows from the Strait of Hormuz head to Asia.
Right.
When those routes are delayed by complex toll negotiations, or when Western ships are forced to reroute entirely around Africa, it creates a massive supply bottleneck.
Sure.
The shipping companies do not absorb the cost of a 2-week detour around the Cape of Good Hope.
Of course not.
They pay vastly higher fuel costs, they pay skyrocketing maritime insurance premiums, and they pass every single cent of that down the supply chain.
So the manufacturer pays more for the energy to run their factory, the distributor pays more to fuel their delivery trucks, and the retailer passes all of those compounded costs straight to the consumer at the checkout counter.
Exactly. And there is very recent historical precedent for this. The report notes that during periods of heightened tension in the region between 2022 and 2024, oil flows through the strait dropped by roughly 1.6 million barrels per day.
Wow, just disappeared from the market.
Yeah, and the market instantly prices in that scarcity, which inflates global oil premiums across the board, regardless of where you live.
See, when you combine the physical supply chain inflation with this massive structural shift in global finance, it paints a pretty intimidating picture. I mean, you hear a term like de-dollarization thrown around online, and it sounds apocalyptic. Are we looking at the imminent collapse of the US dollar? Will the cash in our bank accounts become worthless in the next 5 years?
Yeah, I hear that a lot. But the data in our source material acts as a vital reality check against that panic narrative. The U.S. dollar is not collapsing tomorrow.
Okay, good.
Despite the rise of embrage and the massive gold accumulation by BRICS nations, the U.S. dollar still dominates over 80% of all international trade transactions.
80% is still massive. It is incredibly sticky. It's almost like a universally spoken language. Like if an air traffic controller in Tokyo is talking to a pilot from Brazil, they speak English.
Yes, exactly.
The entire global infrastructure is just wired to speak the dollar. And ripping out that wiring takes decades.
That is an excellent way to frame it. The infrastructure is deeply entrenched. What financial analysts are observing is not an overnight cliff. It is a slow transition to a multipolar landscape.
So the regional hubs are starting to develop their own local communication networks to bypass the English-speaking main towers, so to speak.
Perfect analogy, yeah.
Yeah.
The petrodollar system isn't imploding, but its influence is diluting. Over time, as fewer countries recycle their trade surpluses into U.S. treasuries, the U.S. will simply have to adapt to a world where it cannot finance its national debt as cheaply or as easily as it did back in the 1990s.
Well, we started this deep dive looking at a tiny geographic bottleneck. We saw how a $2 million yuan-only toll imposed by Iran in the Strait of Hormuz is acting as a forcing function, really leveraging physical geography to accelerate a 50-year shift away from the petrodollar system.
And it's moving fast.
It really is. We traced how that is pushing a bloc of over 40 nations toward alternative digital payment networks like Mbridge, and how it has triggered the most aggressive central bank gold rush the world has seen in 60 years.
It clearly illustrates the profound vulnerability of a global financial system that still ultimately relies on moving physical commodities through easily disrupted geographic corridors.
Which leaves me with a final thought for you to mull over. We've just explored how a single physical choke point in the ocean can be weaponized to force a massive shift in global currencies today. But what happens tomorrow? As central bank digital currencies and decentralized blockchain networks evolve to bypass physical borders entirely, what will anchor the value of money? Will the dominant global currency of the future still rely on its connection to physical resources like oil and gold, or will its power come entirely from the undeniable efficiency of the technology that moves it? Thanks for joining us on this deep dive. Keep asking questions, keep looking past the headlines, and we'll see you next time.